The reason why the interest rate paid by Australian borrowers has become largely disconnected from the RBA cash rate can be summed up by this graph in the Weekend Australian Financial Review on the 13th of September. It is a graph of Australia's current account deficit. You don't have to look closely to see the solid high bars from 2002 onwards. Simplistically, this means that Australia has been living beyond its means. We've become highly dependent on foreigners to fund our overconsumption on housing, four-wheel drives and plasma TVs. It was simple to fund our current account deficit during the easy credit period, but now that the world is experiencing the opposite, a credit crunch, the opposite is also true. Because of our long-term dependence on foreign debt and our high level of personal indebtedness, Australia is seen internationally as a higher risk. There are a couple of things to back this up. Firstly, notice how quickly our dollar drops whenever the credit markets begin to seize. That is because foreign investors are pulling their funds out of Australia. Secondly, in the latest statement on monetary policy, the RBA noted that our banks are paying more for money. More significantly, they stated, and I quote, "The average term to maturity of bank bonds issued so far this year has been around 2 years, compared with around 4.5 years prior to the recent disturbances," end quote. This means that, while banks are managing to fund their loan activity at the moment, they need to go to the markets more and more frequently, which leaves them at the whim of international credit markets. That has two major impacts on borrowers. One, Australian banks must stay in good financial shape if they are to obtain sufficient funds at a reasonable rate to lend out. And two, disruption to credit markets, like last week, will place a lot of pressure on banks to raise mortgage rates promptly. In a worst case scenario, if banks were unable to continue to fund our current account deficit, the RBA and banks would have little choice but to jack up interest rates to force Australians to live within our means. Saul Eslake of the ANZ said in an interview with Helen Daly at the weekend that, if the current cost of funds persisted, the RBA would need to reduce its cash rate by 0.5% to prevent an increase in the mortgage and other interest rates. Now, you might realise that the RBA and government have been saying that our banks are in strong shape. Just realise that both are in the business of talking up our bank's strengths so that they can continue to access those vital sources of foreign money. The problem that I have is that, in doing so, they are not presenting the whole truth to the Australian public. Consequently, some Australians are taking on far greater risk than they understand in borrowing to purchase houses and other assets which are likely to decrease in value over the next few years as the easy credit period continues to unwind. Thank you. www.geocities.com/homesforaussies. Standing up for affordable housing for all Australians. Written and spoken by Dr. Brett Edgerton, founder of Homes for Aussies.